Hi, I'm here with Seth Julian, the global strategist for Alvexo. So, how are you today?
Well, very well today. We're here at the
UK
UK Investors Show, and we're meeting a lot of interesting people, talking about some very interesting things, particularly the capital markets and how we as a brokerage can help people benefit or at least minimize their adverse effects of what's a very rugged piece of real estate we're traversing.
Yeah. So, you're a broker. You're here at the Investor Show. What vibe are you getting at the Investor Show? Are you seeing lots of investors? Are you feeling energy for people wanting to?
Feeling pain.
You're feeling pain.
Feeling pain. People who have portfolios been severely damaged. The stocks are selling off. We're in a recession. Leave there be no doubt about it. The textbooks define a recession as a 20% decline. The NASDAQ has been there last week. The S&P hit this yesterday at the close of business, I believe, or in the middle of yesterday. And forget the textbooks. We're in a serious decline. We're in serious trouble. Interest rates are going up. The earnings reports season has made it clear that projections for the next quarter are bad. What do? How do you manage that? How do you minimize your losses? How can you? And I forgot to mention the Russian assault on NATO or the NATO assault on Russia, depending on how you look at it. So we're in some deep trouble, and we are here to recommend opening an account with us because we can help you navigate those waters.
Okay, well, we'll talk about the state of the market in a bit, but just give me the overview of the company there and the elevator pitch.
We're an online brokerage, humble, modest. We're stand-up, straightforward, honest brokers. We don't make money all the time. Some of our advice is wrong too. We have, we lose money like everybody else, but we do the best we can for our brokers, and over the long term, we make more money than we lose, and that is the sine qua non of our business.
Okay.
But I just don't want anybody to have any illusions that this is some get-rich-quick scheme. This is hard work. It's a real business, and you have to put your time in. But that being said, clients today find a dearth of support. I think what I'm really referring to is an old school approach where your broker called you up, she informed you about things you may not have been aware of, helped you, made you aware of situations in your own portfolio that may be more risk than you understood, and helps you navigate that. That's what we do.
Okay.
That's our
So
specialty.
your differentiator is what? You have more personal touch with your
personal, honest, right? We have people.
Okay.
And we have a very diverse offering of holdings, stocks, commodities, FX, indices, bonds. We're going to be moving into, we currently trade derivatives, CFDs in specific, but we're going to be moving into stocks this quarter. So we're expanding. We're offering our principal advantage for people who want to open an account with us is that we are friendly, we're helpful, courteous, kind, obedient, cheerful.
Okay, so they can expect a personal relationship, someone calling them up and recommending different investment strategies, etc.
Precisely.
Okay. So you said about being in a recession. Of course, we have seen the markets that really come off significant highs in the last 2 weeks. So what's the state of the market in your opinion?
Terrified. The markets, anybody your age certainly, I'm a little older, but people who've been in the market for the last 30 years they've seen only free capital. Cost of capital, which is commonly called interest, has been pretty much zero. And there's an old expression on Wall Street that says, when the tide goes out, you see who's swimming without a bathing suit. It may have been attributed to Mr. Buffett, but I'm not sure. What that means is, when money is cheap, everybody's wearing a $10,000 wristwatch and appearing to be very profitable and productive. When you have to pay for the money you've borrowed to get into your business, all of a sudden you're not so profitable. Nobody's buying $5,000 wristwatches, and sales decline. And activity slows down, and people become more fearful. That's called a recession. People recede from the market, and we see this in the Q1 reports. Interest rates are surely rising because the central banks are traditionally behind the eight ball. When you hear them say words like inflation is transitory and with data oriented, when you hear that, you know they don't know what they're talking about. I'm reading the paper. I see it's the interest rate is the inflation. Why aren't you raising interest rates? Because they're late. So yeah, we headed into some very choppy waters, and
so when you say choppy waters, what are you talking about?
Harder to make money.
When the end of free money, cheap money is
gone.
Money,
easy money is out. I just do want to point out one small statistical fact. The markets were beginning to decline before the plague hit, and once the plague hit, there was a sharp drop and then a vast, robust recovery. Well, that's over. People have bought all the the home microphones and cameras and keyboards that they needed, and they've fixed up their homes to be more cozy. And most importantly, government largesse is done, and we're in a recession. And people who are holding stocks based on the previous scenario are now losing money on paper. Now, if your horizon is beyond the terms of this volatility, you don't care. What I'm saying to you is irrelevant, because by the time you're going to, a man like you, by the time you're going to liquidate your stock holdings, this will be just a little blip in history. If, on the other hand, you need to liquidate that money shortly before this volatility is past, you got to take some defensive activity, or you're going to take it in the wallet. So
How long do you see the volatility going on for?
Well, certainly for another year or 18 months, guaranteed. Okay. I'm not guaranteed. I'm not allowed to say that, nor is it prudent to say that, because I don't know. I can't say. I don't have a crystal ball, but I can tell you what other experts say. The Fed itself says they're going to be raising interest rates at least to 3% by the end of this year. And that's going to be another 1.5% at least until the middle of next year. So certainly inflation is a psychological phenomenon. Don't be misled by charts and graphs that look scientific. This is human psychology. Mm-hmm. And prices rise because you think they're going to rise, and then they rise because you raise your prices, and you raise your price. It's insane. It's a mania. It's very difficult to control, and it doesn't go away quickly.
Mm-hmm. So how can investors position themselves then to capital? Well, one, protect the capital, but two, to actually find the opportunities within the chaos for the next year to 18 months.
Let's take the case where they're interested in minimizing or benefiting from the current. If you're in for the longer term, you really don't care.
Don't worry so much.
But let's say you're worried.
Okay.
First thing you want to do is minimize your losses. If you are taking hits in the tech giants, Apple, Microsoft, you're going to get the hell out of them. Sure. Liquidate those positions. Even go short, which at our house is easily done through the derivatives products of CFDs. Very easily done to short. It's possible if you own the actual underlyings, but harder and more expensive. There are opportunities in assets that will benefit from this, but it's so severe. The traditional hedges, like your Walmart's, Costco, because the idea is, well, no matter how bad it gets, people need to go to Walmart to buy their basic needs. Well, they've taken serious hits. Target lost 25% of its capital in the first 3 days of last week. Yeah. Mind-boggling. The bond market, as inflation has taken hold, and inflation's taken hold pretty much since the plague started. There's a shortage of containers, and I'll give you a very simple background on that. For the first time in economic history, governments mandated that their working population do not go to work. In every other war, plague, famine, pestilence, they said, just go to work. Just keep on working. Don't let us down. Keep on pumping out whatever you're pumping out. This time they said, no, stay home. Everything shut down. Yeah. And then they started to work from home, and the demand skyrocketed. There was no supply to meet it. Inflation. Not enough shipping containers and vessels, and they couldn't gear up, and there's still a chip shortage. And you see that the reverberations are much longer than the actual shock wave. So that's not going to go away too fast. Okay. And I haven't even mentioned the assault on NATO, the NATO assault on Russia, however you choose to look at it. You hear this all the time. Well, it'll be over in a few months. It's going to be over in a few months. The Russian army may be rotten and ineffectual, but they are effectual. Grozny is no more. So it doesn't take 6 months, but they're going to achieve their aim. We are not of the opinion that Putin is a madman or a monster. He told us what he was going to do in 2008. He reaffirmed it in 2011. He made it clear in 2012. He made it clear when he took over the Crimea. And the West had these fantasies, these 21st century fantasies. Well, these people want to be democratic, and we should really help them. We try to maintain a realistic outlook toward things.
So there's lots of uncertainty, lots of change going on.
Plenty.
Do you see further declines in the main indices? Yeah.
Yes, the indices have only started to decline. They've fallen off their all-time highs, depending on which one. Except for the Tadawul, which, because it's so Saudi Aramco driven, and Saudi Aramco is entirely driven by the price of oil, leaving the Tadawul index out. They're all off their highs, and they're falling off the cliff, and they're going to continue to fall off the cliff. They've been overpriced for years. One of the reasons they've been overpriced is because capital is cheap, free.
Yeah, exactly.
So stock prices have risen, to price earnings ratios, which is a standard statistic of stock value, to really, really ridiculous levels.
Yeah, the bubble's very big. Should investors look to get into inflation hedges such as gold?
Interestingly enough, I would normally have, my reaction would have been, yeah, absolutely. Except now, no. Gold is doing nothing.
So where do you go then?
Well, bonds, selling bonds, if it's buying or selling.
Well, I would say buying. Let's not talk about shorting. Maybe you can short.
That I believe is a strategic lacuna.
Okay.
You should consider shorting very seriously.
Consider shorting. Yeah, take advantage of the downturn. But if you're not into that, is there anywhere you can go to?
If you want to buy something for the long term and things that are going up, yeah, I'm afraid this may be slightly depressing, Mark.
Okay, all right.
I want you to look at
Bailey's, for everything, for
Rheinmetall, and Lockheed Martin.
Okay.
The armaments that have been shipped to the Ukrainians were not new. The United States and NATO drained their arsenals. Those arsenals are going to have to be replenished.
Yeah, okay.
Walmart does not replenish that stuff.
Sure.
Bailey's, Rheinmetall, Lockheed Martin.
Okay. So military. Okay.
Unfortunately.
Okay. Otherwise, you go for a short and try to
buy wheat.
Yeah.
Buy wheat.
Wheat. Yeah.
Between Russia and Ukraine, they account for 60% of the world's export of wheat.
Yeah, exactly.
I don't see the world going on a gluten-free lifestyle anytime soon, because while that supply has been removed from the market, or mostly it'll find its way through black market channels into the supply lines, largely it's been off. And so, again, and classical economics doesn't tell us that much about human behavior, but in this case it does. Mm-hmm. When supply is diminished and demand remains stable, price goes up. Yeah. Price is going up.
Well, thank you for giving us your snapshot of the markets. It's not the rosiest picture, but we have to be realistic about it. Just a final thought. You're here today to meet investors who perhaps would like to open an account with you to get exposure to the markets and better their future. What would be your message to people who are considering taking advantage of this or looking for a broker such as yourself?
Be clear-eyed. This is not a market for the faint of heart.
Okay.
People who have been in the market for the last quite some time have had a great ride. All-time highs. Every week you'd open it up, all-time highs. The IPOs, people making zillions and billions and trillions and millions. Companies that had no sales and run by people in shorts and sandals making billions. You have to be clear-eyed. You're going to have to be calculating.
Okay.
But just to leave on the final note, there are tremendous opportunities here.
Okay.
And let me just leave you with one quote. This is from the old man Rothschild, who started the banking empire in the 18th century. In what is normally considered to be a deeply depressing quote, he says, when the streets are flowing with blood, it's time to buy.
Yeah.
What that means is it's going to come back.
Yes. Yeah.
So I leave you with that gruesome metaphor.
Good metaphor. Okay. Well, Seth Julian, thank you very much from Alvexo. People want to find you. What's the best way to Google Alvexo?
Google Alvexo. We're there. There's a million ways to get us. Anybody at the show today can scan the QR code. We do our best to maintain a presence. You should find us.
Okay, excellent. Well, that was
Mark.
Seth Julian. Thank you very much for your time today.
Bye.
We'll be back with more later on.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.